As we leave behind us an interesting week, we open a window at what next week has in store for the markets. On a monetary level, we note the release of BOC's interest rate decision on Wednesday, which could be of interest for CAD traders, while Fed policymakers are to remain silent ahead of the Fed's meeting on the 1st of February, which may allow for some speculation on behalf of the market for the Fed's intentions. As for financial releases, we highlight on Tuesday the release of the preliminary PMI figures for January of Japan, France, Germany, the Eurozone, the UK, and the US, and New Zealand CPI rates for Q4. On Wednesday, we get Australia's CPI rates. On Thursday, the highlight of the week is due out, namely the US GDP advance rate for Q4. The US dollar is about to end the week near the same levels it began against its counterparts, maybe a little bit higher. On the monetary front, we note that we had some mixed signals from Fed policymakers in the past few days. Overall, though, we note that given the statements made in the past 2 weeks, there seems to be a consensus building up among Fed policymakers that the bank is to ease its aggressive stance and downshift its rate hiking path. On a macroeconomic level, we note that the retail sales growth rate dived deeper into the negatives than expected, as did the industrial production growth rate, while the PPI rate slowed down more than expected, all for the month of December. We consider the financial data released on Wednesday as a result of the Fed's monetary policy tightening, which are signaling that economic activity is contracting, the demand side of the economy is weakening, and inflationary pressures are cooling off in the US economy. On a fundamental level, we note an issue that tends to pass under the radar. It seems that the US government is about to hit the debt ceiling, and for it to be able to borrow more, it will require approval from Congress. Given that the House of Representatives is controlled by the Republicans, Biden's government may have to curtail its expansionary fiscal plans and provide concessions to the Republican Party. The pound is about to end the week high against the US dollar, the euro and JPY in a sign of a broader strength. On a fundamental level, we know that the UK government's major issue is the cost of living crisis. On a macroeconomic level, we note the slowdown of inflationary pressures in December, yet at the same time, we also highlight that the slowdown may prove insufficient, given that the rate remains at a 5-fold high if compared to BOE's inflation target of 2% year-on-year. Furthermore, we note that the UK employment data for November showed that the UK employment market remains tight, and the acceleration of the average earnings growth rate may continue feeding inflationary pressures. It's characteristic on a monetary level that BOE Governor Bailey stated that the worker shortage may pose substantial risks for the cost of living crisis. On the other hand, though, on a more optimistic note, BOE Governor Bailey also stated that there could be a rapid slowdown of inflation in the UK should energy prices start falling. Overall, though, we tend to agree with the market expectations that the bank may proceed with a 50 basis points rate hike in its next meeting, possibly maintaining a hawkish approach, which in turn could provide some support for the GBP. JPY is about to end the week lower against the USD, the euro and the pound, showing a general weakness of the week. The main market mover for the yen in the past few days was BOJ's interest rate decision. BOJ failed to tweak its ultra-loose monetary policy, as was expected by a number of market participants after December's tweak of the yield curve control policy. The release brought BOJ's dovishness in direct contrast to the market expectations, sinking JPY. For the time being, we expect BOJ's dovishness to continue weakening JPY as monetary outlook differentials widen. On a macroeconomic level, note that the headline CPI rate accelerated for December, another indication in contrast to BOJ's ultra-loose monetary policy. On a fundamental level, we have to remind our readers of JPY's dual nature as a national currency and a safe haven trading instrument. Hence, should the market sentiment become more cautious, we may see the JPY getting some support and vice versa. The common currency is about to end the week slightly high against the US dollar, high against the JPY, and is losing ground against the pound. On the monetary level, we expect the ECB to maintain its hawkish approach and continue hiking rates in its coming meetings. It's characteristic that ECB President Christine Lagarde stated in Davos that we shall stay the course until such a time when we have moved into restrictive territory for long enough so that we can return inflation to 2% in a timely manner. Overall, we expect, given that inflation remains far higher than the bank's 2% year-on-year target, that the pressure on the bank will be considerable. On a macroeconomic level, though, we must note that the HICP rate for the Eurozone was confirmed to slow down for December, the second in a row, in a sign that inflationary pressures are cooling off. Overall financial data seem to imply that the Eurozone may be on the right track, yet there is still some way to go. On the other hand, a continuous monetary policy tightening from ECB could endanger growth. Hence, we highlight the preliminary PMI figures for January next week, which are to indicate the level of economic activity in the area. AUD is about to end the week lower against the US dollar, breaking a 4-week winning streak. On a macroeconomic level, we highlight that the easing of the Australian employment market for December tended to contribute to the weakening of the Aussie. The release could ease any hawkishness of RBA, as per the bank's last interest rate decision. Hence, the next big question is inflation. The release of the CPI rates for Q4 on Wednesday is expected to be closely watched, and should the rate accelerate, we may see the Aussie getting some support, as that may spur RBA's hawkishness once again. On the fundamental side, we note that China's reopening may continue to play a supportive role for the Aussie, given the close Sino-Australian economic ties. Also, on a fundamental level, we note that the market sentiment is to play a key role for the Aussie's direction, given that it's considered a riskier asset as a commodity currency. A possible improvement of the market sentiment could support AUD and vice versa. The loonie is about to end the week lower against the US dollar after being for 4 consecutive weeks in the greens. On a macroeconomic level, we highlight that Canada's CPI rates failed to accelerate and pair the stellar employment data for December to intensify the hawkishness of BOC. The release may have eased market expectations for a rate hike in Wednesday's meeting. CAD ORS currently imply a probability of 64% for a 25 basis points rate hike. We tend to concur with the idea that the bank will deliver such a rate hike, yet we may see the bank easing further its hawkishness in order to stop hiking rates altogether at some point. Depending on the easing of the bank's hawkishness, the rate hike may turn to a dovish hike that could weaken the CAD. Hence, some caution is advisable. On the other hand, given that a considerable part of the market expects the bank to remain on hold, a possible rate hike could provide some support for the CAD. On a fundamental level, we note the positive correlation of the CAD with oil prices. Oil prices for the week are about to edge a little bit higher, and should oil prices get more support, we may see the positive sentiment being transmitted to the CAD as well, providing some support. As a closing comment, we note that the US dollar may regain some of the initiative over other currencies in the coming week in the FX market, mainly due to the release of the preliminary GDP rate for Q4. Other than that, we may see financial releases from other countries taking the lead, redirecting attention to other currencies. The calendar could prove to be a nice mix of financial releases with a more balanced blend of trading opportunities. However, due to the earnings release period, we expect market attention to remain on the US stock markets. Market worries about the outlook of the US economy and the possibility of the Fed over-tightening tend to increase the bearish sentiment in the US stock markets. It was characteristic that all 3 major US stock markets, the Dow Jones, Nasdaq and S&P 500, are about to end the week in the reds, and the fact that a number of companies in the earnings releases seem to be missing their revenue expectation tends to intensify market worries. In the coming week, we note on Tuesday the release of Microsoft, Lockheed Martin's, General Electric's and J&J's earnings reports. On Wednesday, we get Tesla's, AT&T's, IBM's and Boeing's, while on Thursday, we note the release of Visa's, MasterCard's and Intel's earnings reports. Finally, on Friday, we note the release of the earnings reports of Chevron, American Express and Colgate-Palmolive. As for gold, it seems to remain at the same levels as the week began, failing to take advantage of USD's relative inactivity. In the coming week, we expect the precious metal to maintain its negative correlation with the US dollar, and should the greenback start gaining, we may see gold's price retreating. We hope that you found this report useful. From all of us here at IronFX, best wishes for solid trading.
In today's session, we will look at platinum as a trading instrument and its appeal to investors. The precious metal has posted significant gains the last few years, especially due to rising demand after COVID-19. However, it is often ignored by investors who turn to gold and silver markets due to the higher volume. Platinum is important for the growth of the hydrogen economy, and demand could expand even further, posing plenty of opportunities for platinum buyers. In the meantime, there are possible trading risks to consider, including a strong USD and falling platinum demand. The pandemic has changed many things and unsettled demand and supply in platinum. While jewelers and car makers were not so interested in the metal as in earlier years, COVID-19 has driven money to precious metals, with many investors turning to platinum. At the same time, its supply was also hurt as lockdowns did not allow for its mining. Platinum is mined in South Africa, in Marikana, with the first platinum nuggets being discovered back in 1924. Anglo Platinum in South Africa is considered to be the world's largest producer of platinum. 7 million and 8 million ounces of platinum are used each year. Platinum plays an important role in renewable energy, especially in electrolysis and in the fuel cells that use it. The hydrogen economy refers the use of hydrogen as a fuel for heat, hydrogen vehicles, energy storage, and transport of energy. The use of hydrogen promises to reduce fossil fuels and limit global warming. Many countries, including the European Union and China, have pledged to reduce carbon emissions by 2050 to 2060 and are invested in hydrogen power. Renewable hydrogen technology generates gas from water and stores it in fuel cells to be used in homes and vehicles. The wider use of hydrogen technology in the near future will require increased quantities of platinum. The limited supply of platinum, coupled with the possibility of hydrogen technology boosting demand for platinum, provide a bullish outlook for the precious metal for the coming years. Investors would be interested to see what will happen to the precious metal and its role in hydrogen economy, but also whether automakers will return to platinum in the future, as the current prices are a strong incentive. This could also push demand for platinum higher. Thank you for watching.
Okay, hi everyone. Welcome to today's webinar. So today we'll be doing Fibonacci series, our first part of 4 on retracements. So we'll give a couple more minutes to let more people join our meeting. I will start perhaps at 6:05. So you can, in the meantime, you can grab a drink, get yourselves comfortable, and then we'll start in a couple of minutes. Maybe in the meantime, I'll do like a sound check. Can everyone hear me? And can you see my screen? Yeah, okay, that's great. chat is disabled. Okay, let me try and sort that out. Thanks for letting me know. Okay. Okay, maybe you can try the chat again. I've just tried to refresh the chat. It says everyone can type in the chat. Hmm. Okay, let me try and figure that out. But this Q&A works. I can see all of your questions, so that's great. Okay, let me try and figure it out. Okay, can you try now and let me know if it works? Okay, that's great. Okay, there was something with the settings. But yes, I've managed to figure out. Yay. Okay, how's everyone doing today? Yes, Sven, it works now. No problem. Okay. So, where are you guys from? Today is actually my first webinar in a couple of months. So it's good to be back. No, today I'll is the first session for the Fibonacci series. So it'll just be on retracements. Things like the expansions, extensions, and projections will be in the coming weeks. So today we're just solely focusing on retracements. Wow, Finland and Germany. I bet it's really cold there now. Singapore is hot all year round, so I can't relate. Okay, I'm just checking to see if everyone is here. See if I should wait a little bit longer. Yeah, because people are still joining the call, so just be patient with me. Okay, Sven says it's -3 degrees right now in Germany, and in Singapore it is, I think, 27. So -3 must be so nice. I'm sure the weather is like so nice and relaxing. Whereas in Singapore we're constantly sweating. It's uncomfortable. Oh, remember, you guys can just let me know in the chat throughout the webinar if you have any questions. Oh, we have someone from Mozambique and another from Africa. That's so cool. I forgot how international these webinars are, so it's so nice to speak to people from all different parts of the world. Okay, I think we can begin. Okay, yeah, let's begin. So Hi guys, I'm Melanie. Today is my first webinar, so be patient with me as I get back into the swing of things. But today we'll be going through the first part of our Fibonacci series. It'll be on retracements. So if you have any questions on projections or expansions, we'll be touching a little bit on that throughout the webinar, but we'll go more in depth in the coming weeks. So as usual, our disclaimer, the information in this webinar should not be considered as investment advice or recommendations, and it's solely educational material only. So take any piece of information from this webinar at your own risk. And IronFX is not responsible for any loss arising from any information contained herein. Okay, so this is me. I'm Melanie. Yeah. Okay, let's just begin. Okay, so here's our agenda for today. Firstly, we'll be going through the essentials of Fibonacci retracement, followed by the ideal market structure. So what you can look out for, significant swings, how important it is to follow market trends. And then we'll be going through the different Fibonacci levels. So we'll also be touching a little bit on expansions as well as Fibonacci extensions. We'll also be talking about the difference between those as well and how to look out for them when you're trading. So after that, we'll be going through how to combine the Fibonacci retracement levels so that you can increase your chances of a profitable trade. And then we will introduce something called the Fibonacci confluence area as well. And then, this is a typo. After that, we'll be going more in depth, talking about the negative Fibonacci levels as well as the levels more than 100%. Okay, so let's begin. So here's a simple checklist to follow when first starting out with Fibonacci retracements and some things to look out for. So firstly, is the market structure clear? So we like to look for really big zigzags. I'll show you what we mean in the coming slides. Secondly, we want to identify recent trends. So is the price going up or down? It's important to always follow the general trend. So you can see in the image that I have included over here at the bottom, our starting point is at the top and our ending point is at the bottom. So we can see that there's a very clear downward trend. Okay. Thirdly, you need to identify recent major swing lows and recent major swing highs. So we'll also show you some examples of this in the coming slides. So it's also important to connect the two extreme points, so from highest to lowest or lowest to highest, depending on the general trend. So we'll show you why this is important in the next few slides as well. So over here, we have an example of insignificant swings. So you can see the charts are rather choppy. There isn't really a very clear price movement. And this is what you want to avoid. So this is an example of something that you should not use Fibonacci retracements for. Okay, and this is something that you should look out for, significant swings. So something that has very obvious peaks and troughs. Yeah, over here. And a very clear move up or down. You also want to make sure that you look for a very clear market structure. So Fibonacci retracements should not cut through too large areas of the market structure. You definitely can, but it shouldn't deviate too much from the price movement. So in this case, we can see there is a zigzag structure, and the retracement drawn here cuts through the market structure, which makes it less effective. So when drawing your trend line, you want to make sure that it doesn't deviate too much. Because you can see from here, our starting point is here and our ending point is here, which cuts through a very large area of the price movement. Okay, let me just check. I'm just checking the chats to see if we have any questions. Okay, someone asked what time frame should be used. I'll get into that in a second, but mostly we want to use the larger time frames so that there's less noise when you're trading. Okay, so this is an example of something that you want to do. So you want to pick market structures with really clear upward or downward movements. As you can see over here, the starting point is at point 1, ending point at point 2. So you can see a very clear downward general trend. Even though it does cut a little bit over here, but that's fine because it doesn't deviate too much from the price movement. Okay. So answering your question earlier, these tend to work better on higher time frames. So like H1 onwards, H1, H4, and so on and so forth, because there's less noise compared to your M5 or M15. Okay, so this is an example of a clear market structure. So although Fibonacci retracements definitely can be used for both choppy and trending markets, and what I mean by trending markets is markets that have like a really general trend, like earlier in the earlier slides. But over here, you can see there's quite a bit of movement, but the Fibonacci retracements can be used for these as well. But it's important to look for clear market structure. That's the main point. Over here, you can see this is an example of an unclear market structure. Okay. So one thing we can do to find clearer market structures for our Fibonacci analysis is to adjust the time frames so that the market structure is clearer. So what might look messy on an M30 chart might look very clear on an H4 chart. So I'll show you in the next slide. So if there's too much chaos in the shorter time frames, it doesn't mean that the entire currency pair is not able to be analyzed at that point of time. It could just mean that you need to take a step back to get a clearer view. So I'll show you what I mean in this upcoming slide over here. So this is an example of a chart on an M15 view. So you can see there isn't really a very clear trend, no clear market movement as well. But if we zoom out and we look at the 1 hour time frame, it's quite clear, especially in this highlighted area. So we have much clearer movement, and it's less messy compared to the M15 one. Okay, any questions so far? No? Okay, let's move on. Okay, so from the past few slides, this first section, it's important to note that the clearer the swing low or swing high, the clearer the trend between the 2 points, the more accurate your Fibonacci retracement will be. So that should be the main takeaway from the first few slides. Okay, so now that we know how to draw Fibonacci retracement trend lines and we know what to look out for, let's look at the different types of levels ranging from negative all the way to more than 100. So in the negatives, we have minus 61.8 and minus 27.2, which are classified under Fibonacci expansions. And all of these in the middle are your Fibonacci retracements. And then above 100 will be Fibonacci extensions. So like I said earlier, we'll go in more in depth in the coming webinars, but we'll just briefly introduce them and how to go about using them as well. Okay, so over here it just shows you an example of all of the levels that I've mentioned earlier. So for here, the starting point is at this level. Oop. Ending point is over here. Okay, so here's an example of the Fibonacci expansion and how it plays out. So our starting point is here, ending point is here. So for expansion, you want to look for a flash zigzag, which you can see over here from the arrows. It's like a flash kind of symbol or a lightning bolt. So you want to look out for these when you identify Fibonacci expansions. So you retrace the mid-range from here to here. And you make use of the support in the negatives, which means like the negative 27.2 and the negative 61.8. So we expect price to retrace back up to the 61.8% level because price has tested this level earlier, as you can see over here. So it tested this level and then it reversed off. So we expect it to come back down to this negative 27.2 or even negative 61.8. So I'll show you in the next slide how it actually plays out. So here we see the price really reacted off of our minus 27.2%, and then it came back up to our ending point. So typically price, not always, but typically price will come back to the ending point after bouncing off a negative Fibonacci retracement. Sorry, a Fibonacci expansion level. Okay, so let's move on to Fibonacci extensions. So those beyond 100%. So when using the 127 and 161.8 levels for extensions, we want to look out for the V shape or Nike tick as shown here. So in this GIF, you can see how price bounces off of these levels. Let me just start it all over again. Okay, here. So this is our starting point. The shorter end of the tick is your starting point and ending point. And then price will continue to rise from these levels. And after it's reached this level, it reverses off it. We can see over here that it tested the level once again, but it ultimately bounced off it to reverse and drop back down. Okay, let's move on to the next slide. Okay, so when does a Fibonacci retracement become invalid? So one of the most common scenarios of this is when price makes a lower low. So assuming you are drawing a Fibonacci retracement from the top to the bottom, if there are bars on the right that break your ending point, it becomes invalid. So there are Fibonacci retracements that are negative, so like the negative 27 and negative 61.8. And we'll touch on these as they go basically beyond the endpoint, and yet they are still valid. So I'll show you what I mean over here. So this is an example of an invalid retracement. So the ending point, which is here, you can see that price actually reversed off the ending point, but it made a lower low. So this Fibonacci retracement over here, the trend line, is now invalid. Sorry. So similarly, if it's going higher, if it breaks the ending point and it goes even higher, then it's invalid as well. Any questions so far? No questions? Okay, let's move on. Okay, repeat the last bit. Okay, so how you identify once your Fibonacci retracement is invalid is when, so you can see over here, price is moving downwards. In this case, it's a downtrend. So when it's moving down, do you use this lower low as a new ending point? Yes, correct. Yeah. So you can see it's moving downwards. This is originally our ending point. But since price reversed off this level and went even lower, so this should be our new ending point. So even though I said earlier that you shouldn't cut through the price movement too much, in this case, it's not a large area, so you can still cut through this area because the general trend is still downwards. So this should be your new ending point. I hope that's clear. Okay. Any other questions? See the previous slide. Sure. No worries. So the main key point is that once it breaks your ending point, it becomes invalid. Okay. Okay, let's move on. So now let's take a look at Fibonacci extensions. So here you can see a very obvious Nike tick. The starting point is here, ending point is here. For Nike tick, you want to take the shorter end of the tick, the starting point. So you retrace this area, this trend line is over here. And it results in a reversal over here. When you use this trend line, it gave us a 161.8 projected level. So we are expecting it to rise to this level and reverse off of it. Oop. So 127 would be perhaps in between here. So you might want to wait for price to break through the 127 level before going in for this trade at 161.8. Okay. Okay, let's move on. So we've gone through earlier the key Fibonacci levels that work, the expansions, extensions, as well as the retracements. So there's always a huge debate on whether some levels work better than others, but the truth is that Fibonacci retracement levels work sometimes, but they work all the time. So that's the problem. So how do we minimize this issue and increase our chances of being profitable? So what we've come up with that works by combining Fibonacci retracements. How do you expect that it will go to 161 and not 127? Okay, so Yeah, so as I mentioned earlier, 127 would be perhaps around this area. So you might want to wait for price to break through the 127 level before going in for the trade for 161. Because at the 127 level, it could reverse or break through. So you want to wait for it to break through before going in for the trade at 161. Does that make sense? Okay. Okay, no worries, because let me just try and explain it again. Because the 127 level is obviously below the 161 and above the 100. It's in between. Should be in between this area here. So if price hasn't reached the 127 level yet, it's not advisable to go in for the trade at 161 because it hasn't broken the level yet. So it could reverse off of the level or it could go up. So in this case, we know that it went up. So after it breaks through the 127 level, then we can go in for the trade at 161 projected level. Okay, I hope that helps to clear things up. Okay, so let's talk a bit about combining the Fibonacci retracements. So the trick is to find multiple Fibonacci retracement levels that line up together so that you can increase the probability of a bunch of Fibonacci retracement levels working instead of a single Fibonacci level working. So this is the definition of Fibonacci confluence. So we'll show you an example of what we mean and how this can play out in the next few slides. So, okay, maybe I'll start with this photo first. So over here, we have a negative 27% Fibonacci retracement. So you can see this is the starting point and the ending point is here. Okay, so then we have a 161.8 Fibonacci retracement. So that would be starting point here, ending point here. And then we have a 78.6% Fibonacci this should be Fibonacci retracement, sorry. The 78.6. So that all lines up nicely, and we expect price to bounce off of this confluence area, since all three of our Fibonacci levels line up together. And you can see that price really bounced off this area, and it resulted in an uptrend after that. Okay, I have a couple more examples, so if you're a little bit confused, don't worry about it. But if you have any questions, you can pop it in the chat as well. All good. Okay. So here's our first example. So we have a Fibonacci retracement starting from here and ending here. And this gives us a 50% Fibonacci retracement. And the level is in yellow, this level over here. So that's the first one. Secondly, we have a Fibonacci retracement starting from here and ending here. And this gives us this green area over here. And then it lines up nicely with the 50% Fibonacci retracement. Okay. So lastly, we have a 127.2% Fibonacci expansion, starting here and ending here. So ultimately, we have 3 Fibonacci retracement levels all lining up, and it gives us a very strong Fibonacci confluence area. So what we expect is that what we're going for is to play a bounce from a strong area of Fibonacci confluence support, which is basically all the colors lining up this area. Okay, so we'll show you the result of this. So as you can see in this picture, price went down to touch this strong area of Fibonacci confluence support, and it bounced up nicely. Okay, any questions so far? Yeah, so you're combining one big Fibonacci retracement level with 2 other smaller Fibonacci retracement levels. So you can see this is the really big one, and then you combine it with the 2 smaller ones over here, the green and the red. So you just pull out your Fibonacci retracement levels, and then you can just connect from the starting point to the ending point of each. And then you see where the levels line up, and that should give you a strong area of confluence. Okay, hope that clears things up. Okay, let's move on. So here we have another example. So in this example, we combine one Fibonacci retracement with 2 Fibonacci extensions. Okay, so the very first one, let's start with the yellow one. Starting point here, this is our middle point, and our ending point is here. So this is the Nike tick that we mentioned earlier, the Fibonacci extension. Okay, and it gives you an 88% Fibonacci extension, which lines up with the 61.8% Fibonacci retracement. Starting point here and ending point here. You can see a very clear downtrend here, the green arrow. Okay. So for the last Fibonacci extension, we have another flash over here, the red arrows. So remember, for Fibonacci extensions, we're looking for the flash symbol or lightning bolt symbol, however you want to call it. So for yellow, it's like this. For red, like this. So for red, it gives us a 61.8% Fibonacci extension. So we can see that all these 3 levels line up, and it gives us a strong area of Fibonacci confluence to trade from. So what I would do is wait for price to make a push up to this area, because currently price is at this red line here. So I wait for price to make a push up to this area, and when it touches this area, then I would short the market and play the drop. Okay, so this is what I mean by waiting for it to go up to this area and wait for the reversal before you short. Any questions about this second example? Okay, so let me just go back to the previous slide. Yeah, so here you can see there's three different Fibonacci, two different Fibonacci extensions, as well as one Fibonacci retracement. So the Fibonacci retracement is the one in green. Fibonacci extension is the yellow and the red. And how you know this is because of the flash symbol. So like, it's like a lightning bolt. Yeah. Okay. I'm just reading some of the chats or the questions. Okay. Okay, I'll move on. So for the third example, we're bringing in support and resistance levels. And this leads to really high probability setups. So here is an example of how we combine pullback resistance and two Fibonacci retracements as well as a Fibonacci extension. Okay, so I'll show you where each of them are. The red level over here is the pullback resistance. Because price tested this area, it bounced off of it and it crossed this area over here. So this is a pullback resistance. The Fibonacci retracement is the yellow line, starting point here and ending point here. This gives us 61.8% Fibonacci retracement, which lines up with Fibonacci extension, which is over here. We can see the flash sign again in the green arrows. Can you guys hear me? Someone said they can't hear me. I think the audio is fine. Okay, let me just reply. Sorry. Okay. Where was I? Okay, yes. So you can see the flash over here, the flash signal. This is a Fibonacci extension, the green arrows. And then we have another Fibonacci retracement, which is the red arrow. Okay. And all of these three levels line up with our pullback resistance. So it's a very strong Fibonacci confluence. And it's also a high probability reversal zone that has the potential to see price reverse strongly from this area. So in such situations, you could place a short entry over here at this area. Okay, let's see how this played out. So you can see price reversed off of this area. And it reversed right as it hit the confluence area. So because this area is so strong, and you can tell based off of the Fibonacci retracements lining up, as well as the pullback resistance, or any support and resistance levels that line up with the Fibonacci retracements, should give you a very high probability reversal zone. Okay. Are there any questions about any of the three examples that we've gone through so far? Yeah, I'll give you guys some time to digest what I've just gone through from the three examples. Sorry, catching a cold because it's been so rainy in Singapore. Okay, so the main point from all of the three examples is basically to stack a bunch of Fibonacci retracement levels or support and resistance levels to try and get the most high probability confluence area that you can get, and then see whether it has a high potential for price to reverse off of it. Okay, let's move on. So here's some trade management tips with the Fibonacci confluence. So for stop loss, it should always be beyond the key Fibonacci confluence area. So the reason for this is because more often than not, price is attracted to such strong areas of Fibonacci confluence. And if your stop loss is right before instead of beyond it, you'll most likely get stopped out right before the market reverses. And this is one of the reasons most people wonder why they get stopped out right when the market starts to reverse, and then they complain about it. So, but not you, because now you know. So you can see over here, your stop loss is below it or beyond this Fibonacci confluence area. So there's some buffer over here. So just in case the market doesn't go exactly how you expect it to when you buy, so your stop loss is there's some leeway. Okay, so let's move on to the take profit. So your take profit should always be before your Fibonacci confluence. I see the slides are slightly incorrect, but for take profit, it should always be before key Fibonacci confluence area. And the reason for this is because when price reaches the confluence area, there's a high chance that it will not be able to go beyond it. So you can just ignore the slide here, but take a look at the image below. So our take profit is before the big confluence area. Why? Because there's a high chance that it will not be able to go beyond this area. So instead of reaching your profit target, it might reverse back to your entry, or even worse, your stop loss. So this is one of the reasons why people may complain that the market is being manipulated, because they miss their TP, their take profit, by 1 pip. So you should always put it before the major Fibonacci confluence. As you can see, there's also some leeway over here. So um, there should always be a little bit of buffer between the Fibonacci confluence as well as the take profit and stop loss. More of like a just in case measure. Are there any questions? Okay, I think there are no other questions. So that brings us to the end of our webinar. Okay, so before you guys go, let me just pull it up. So IronFX actually has a VIP trading room. I'm not sure if you guys know, but I'm just gonna let you guys know right now. So depending on your deposit, you can access the different premiums. This is on the ironfx.com website. So you can just take a look over here and you get VIP room access. And what I mean by that is over here, this brings you to our page. So let's say, for example, today we went through Fibonacci retracements. So you've been through our webinar, but it won't really help unless you have the space to practice. So the VIP room gives you the space to practice however you want. Let me just remove everything. So we have Fibonacci retracements, extensions, any horizontal rays that you guys want. So for example, if I see that this is a resistance and I'm not sure if my analysis is correct, you can go ahead and type a message in the chat box. So like maybe Desmond, hey, you can see that there are a lot of people in this chat. So if you put it in, there are many people who will be willing to help you, as well as some of our pro analysts as well. I am also in this chat, so you can go ahead and type it in. I don't know why it's not showing up. Okay, but you can tag whoever you want. Hey Desmond, is this resistance valid? And then you can highlight the resistance, link object to text, and then click on this. And then you can just send it in. So we try to reply as soon as possible. I think within 24 hours, you should get an answer. Yeah, so if it works for Fibonacci as well, if you want to check your retracement, like, is this valid? You can go ahead and tag that as well. Link object to text, and then you can choose which level you want. So maybe like 50%, and then it'll choose it for you. So confirm, and then when I go over it, it will highlight it. So whoever is reading your chat will know what exactly you are referring to, and they'll be able to help you better. Same for the Fibonacci as well. 50%, so you can see the 50% is being highlighted. Okay. Okay. If there are any other questions, you guys can drop them in the chat. But if not, yep. Thank you guys so much for coming today. Let me just open the chat. Okay. Yeah, thank you guys so much for coming today. Have a great rest of your week. And I'll see you guys next week. Yeah, I think there is a way to see the recording. I don't think you can download the presentation slides, but the recording for this webinar, yeah, it's being recorded. Let me just see where you can find it. I think you can check the IronFX page, the website. Okay. Any other questions? No? Okay, thank you guys so much. I'll see you guys next week. Yeah, this may be a little bit difficult to understand, but no worries, you can go back and watch my presentation again. Um, and practice it on your own in the VIP trading rooms, and we'll definitely help you out over there. I think it would help you understand better if you actually played around with the Fibonacci retracement levels. Yeah, thank you guys. Bye.
Hello everyone, my name is Emily. In our video today, we will talk about why having a forex trading strategy is important. Trading on the global forex market presents the opportunity for a quick profit turnaround for traders and offers significant potential. However, as the most liquid market in the world, it is both complex and highly competitive. This means that in order to be successful, you need to have a solid trading strategy in place. Forex can be traded in numerous ways, so it is very important that you go with an approach that suits your experience level, budget, and trading goals. Having a proper understanding of the market you're entering into and the strategy that is needed can be the difference between trading success and failure. Choosing a forex trading strategy is similar to buying a new car. There are a lot of choices and they come in different types. It is also important that you test drive a new strategy via demo account before proceeding with it on the real world markets. Thank you so much for watching us today, guys. Bye.